Chapter 3, Taxes. We all have to pay them, so we might as well get this out of the way early on. Here are our learning objectives for this chapter. Basically, we want to understand the U.S. tax system and how we can minimize the taxes we have to pay. Learning Objective 1, identify the major tax types in our society. 2, calculate taxable income and the amount owed for federal income tax. 3, prepare a federal income tax return. And 4, select appropriate tax strategies for various life situations. Most of us get serious about our taxes early each year. Some start as early as January, but a lot don't really start until April, just ahead of the April 15th deadline. Bad strategy. Tax planning should be a year-round exercise. We need to know what the tax laws are, which ones affect us, and how to take advantage of any changes. We need to take taxes into account when making investment and purchase decisions, as well as charitable donations. Our goal is at the bottom of the slide. Pay our fair share, but no more. When thinking of taxes, we all immediately think of the IRS and April 15th, but there are other taxes relevant to us. We all pay sales taxes, and they vary based on where you live. As an example, right here near the DeSoto campus, South Haven, Mississippi rate is 7%. West Memphis, Arkansas rate is 10.75%. Memphis rate is 9.25%. Germantown, Tennessee rate is 9.75%. That's a 3.75% swing within a few miles. Taxes on property include both real estate taxes if you own your own home, and some states have personal property taxes. Taxes on wealth don't kick in until you die, so we'll talk more about them in the last chapter on estate planning. The big one, income tax and Social Security. That's where our focus is going to be. I hope most of you are preparing your own taxes, so much of this will be familiar to you. The first step is to determine your adjusted gross income. This is where taxable income comes from. Taxable income includes earned income as well as investment and passive income. An exclusion is money not included in gross income. The example given is U.S. citizens earning income outside the United States. Tax-exempt income is not subject to tax. For example, income on municipal bonds. Tax-deferred income is income that will be taxed at a later date, usually at retirement. Gross income is adjusted by contributions to IRAs or Keogh retirement plans, alimony payments, and a tax shelter, which is a type of investment that provides immediate tax benefits. Adjusted gross income is reduced by deductions. Each taxpayer receives a standard deduction. As of 2017, the standard deduction was for a single taxpayer, $6,350, married filing jointly, $12,700. Higher deductions are allowed for blind and those over 65. Many filers qualify for more than the standard deduction and itemize their deductions. Itemized deductions require more complex filing, but the higher deduction can be worth it. Including in itemized deductions are medical expenses that exceed 10% of adjusted gross, 7.5% for those over 65. State and local income taxes, property taxes, and personal property taxes. These were a huge issue in the latest tax legislation as it put an upper limit on the amount deductible, which hit high-tax state filers very hard. Interest on home mortgage and second mortgage loans, as well as on investments, is deductible. Charitable contributions are deductible, but you should maintain careful records and receipts for cash or property donated to a verified 501c3. Casualty and theft losses, moving expenses, and unreimbursed job-related expenses were deductible, but were eliminated in the 2018 tax reform bill. For all deductions, you should maintain careful records and receipts, just in case. This is Exhibit 3.1 on page 78 in your text. It outlines the steps in filing your income tax return. Step 1, determine your adjusted gross income. Step 2, take deductions to compute taxable income. Step 3, calculate the taxes owed. Step 4, make the tax payments. Step 5, avoid the penalties. File on time. This is Exhibit 3.2 on page 80 in your text. It outlines the 3 basic areas of records you need to maintain for tax purposes: tax forms and filing information, income records, expense records. On the following slides, we'll walk through each of these in more detail. Pretty obviously, you should keep copies of your tax returns for at least 7 years. 10 is better. If you file electronically, keeping copies is no problem. You need to have the Social Security numbers of all family members covered on your tax returns, and you should also keep any instructions you used in preparing your taxes. The second category is income records. Here's the basic rule. Income is not negotiable with the IRS. If you got it, you need to report it or be absolutely sure you don't need to. You may receive a W-2 form from your primary employers, a W-2P for any pension distributions, 1099 forms for interest, dividends, and capital gains from investments, and 1099 forms for any self-employment income and lump sum payments from retirement accounts. If income is non-negotiable, deductions are, but you need to keep careful records of all expenses you plan to deduct in case you get audited. Receipts for medical and dependent care, receipts for all charitable contributions, receipts for job-related expenses not reimbursed. The 1098 form from your mortgage company detailing interest and taxes paid, and any expense documents for businesses or investments that generate income. After putting all this together, you're ready to compute your taxable income. One last item to consider: exemptions. They were valuable as they directly reduced taxable income. Through 2017, the personal exemption was $4,050 for you, your spouse, and each dependent. The personal exemption was eliminated in the 2018 tax reform bill, but, as the slide says, was offset by higher standard deductions, which we'll see on coming slides. Step 3, calculate taxes owed. Personal income tax rates are progressive, meaning the rate increases as the income level increases. Rates in the table are marginal rates, meaning they represent the rate you pay on the last dollar earned. On the next few slides, we'll see the 2017 and 18 rates so you can get an idea how the changes affect you. Here are the 2017 tables in the text for single, married filing jointly, and head of household. On the next 3 slides, we'll compare 2017 and 18. As you can see from the comparison, some of the rates have gone down and the brackets have gone up, resulting in potentially lower tax liabilities. The same is true for married filers, rates down, brackets up, and for those filing as head of household. For our examples, we'll use the 2017 rates from the text. Remember that table rates are marginal rates, so for this example of a taxpayer with $50,000 of taxable income, assume a single payer, the marginal rate for 2017 from the table would be 25%, bracket value from $37,951 to $91,900. But your average tax rate is lower and is found by dividing your tax liability by your taxable income. In the example, taxable income is $50,000. The tax bill is $8,240. The marginal rate is 25%, but the average rate is $8,240 divided by 50,000, 16.5. This example computes the tax liability for a married couple with taxable income of $95,000. They owe 10% on the first $18,650, or a tax of $1,865. They owe 15% on the amount over $18,650, but less than $75,900, which is 15% of $57,249 for a tax of $8,587. They owe an additional 25% on the remaining amount over $75,900 up to their taxable income of $95,000, which equals 25% of $19,099 for an added tax of $4,775. Their total tax owed is the sum of these, $15,227. So their marginal rate is 25, their average rate is 16. The alternative minimum tax has been an issue for many years. It was originally designed so that high-income taxpayers couldn't avoid paying their fair share. Over the years, income and tax brackets increased, but the AMT levels did not. So some years, many middle-income taxpayers were caught by the AMT. The brackets have changed for 2018, but the intent is still the same. Tax credits are very valuable. They directly reduce your taxes owed. Some available tax credits are listed on the slide. Earned income credit is aimed at working parents with taxable income below a certain amount. Foreign tax credit avoids double taxation. Savers credit encourages saving for retirement. There are adoption credits, education credits, child credits. If you think you are eligible for any of these, take the time to investigate the requirements, as they can make a big impact on the tax you owe. For the majority of us, taxes are withheld from our paychecks on a periodic basis based on our claimed filing status and number of exemptions. People who receive a lot of their income from sources reported on 1099s may be required to pay estimated taxes quarterly. Needing to pay quarterly and not doing so can result in penalties at tax filing time. If you just don't think you can get your tax return together and ready to file by April 15th, you can file Form 4868 to obtain an automatic 6-month extension. The caveat is that you must estimate taxes owed and pay that amount by April 15th with the Form 4868. Note the size of the penalties for underpayment or fraud. The extension gives you till October 15th to file your complete tax return. FYI, most tax preparers automatically file extensions for themselves since they're busy preparing taxes for clients. Learning Objective 3 deals with who is required to file. Basically, all of us. If you're a citizen or resident of the United States or a citizen residing in Puerto Rico, you have to file. There are 5 filing statuses, but most of us fall into one of the first 2, single or married filing jointly. We also have married filing separately, head of household, which is a single individual with dependent children or relatives, or qualifying widow with dependent children. There are hundreds of tax forms, but we want to focus on the main 1040 options. These will have changed based on the new tax laws, but for this course we'll stay with the 2017 versions. 1040 Easy, no dependents, taxable income less than $100,000 and less than $1,500 in taxable interest. You cannot itemize deductions. 1040A is also income less than $100,000, but not as many restrictions on filing as the Easy form. These forms make filing much easier if you qualify to use either one. The standard form is the 1040. If your income is over $100,000, you must use this form. So how to decide? It's based on the amount and type of your income, the number of your deductions, the complexity of your tax situation. The sections of Form 1040 basically follow the steps we've covered. Step 1, fill in filing status and exemptions, if any, 2017. Step 2, record your income. Step 3, enter any adjustments to income. Step 4, compute your tax liability. Step 5, enter any tax credits. Step 6, enter any other taxes. Step 7, record any payments already made, quarterly or through withholding. Step 8, refund or amount owed. Refunds can be direct deposited. Taxes may be paid through direct debit to your bank account. Step 9, the most common mistake is failure to sign your return. Electronic returns are digitally signed. States with state income taxes are usually due on April 15th as well. You need to check with your state for more details. Filing online is now much more common than filing on paper. Over 90% according to the IRS. No more lines at the post office late on April 15th. Unless you qualify with low income, there is a cost to e-file. Usually about $15, maybe up to $40. The Free File Alliance is a partnership between the IRS and tax software companies to allow lower-income filers to file online for free. This slide and the text detail the steps to access Free File. If you believe you may qualify for this service, check it out. Tax preparation software has significantly reduced the time and effort in filing your income tax. The 2 most widely used are H&R Block at Home and TurboTax. I highly recommend that everyone file their own tax returns. It's the only way you'll understand how your financial actions over the year affect your taxes and how to make changes to reduce your tax burden. I have personally used TurboTax for many years. It definitely reduces the time involved. In addition, data is carried over year to year from your previous year's TurboTax created return. If you have an investment account, you can pull data from it directly into TurboTax. In addition, there is an outside free product called It's Deductible that organizes and values charitable deductions of property, such as clothes and appliances, and imports it into TurboTax. Using tax software does require a system capable of handling it, which most nowadays do, and some comfort using a PC, which you should all have. Tax assistance is available from a variety of sources, some better than others. The IRS provides a variety of sources on their website and in person at IRS offices. Note, however, they do not guarantee correct answers given by telephone or in person. There are a variety of tax publications available as well. Most well-known are J.K. Lasser's and Ernst & Young, as well as a free publication from the IRS. The Lasser and E&Y versions are available from Amazon. There are many online sources, but be careful who you take tax advice from. If your tax situation is especially complex, you may want to consider employing a tax professional to prepare your return. There are one-person offices as well as national chains like H&R Block. The IRS has what are termed enrolled agents who are approved experts, and many CPAs and tax attorneys also prepare taxes for clients. If you're thinking about using a tax professional, this slide lists some points to consider. How well trained the person is, how high the fees are, and how they're determined. Fees can be very high, running into the thousands of dollars for a very complex return. Does the preparer suggest deductions you aren't comfortable with? Will the preparer represent you if you're audited? Is this their main business or is it a sideline? There is a National Association of Enrolled Agents and another for tax professionals. They can only prepare a return based on what information you give them. Giving them full information is up to you. If they make an error, it's your error once you sign the return. The text recounts the result of a test run by Money Magazine. They gave the same data on a fictional family to 41 tax preparers. The cost ran from $375 to $3,600. The tax owed ran from $31,846 to $74,450. Be especially leery of tax refund anticipation loans. These are very high rates short-term loans and should be avoided. So what if your return is audited? If you keep good records and receipts and file correctly and honestly, you should be in good shape. Exhibit 3.7 is on the next slide. From your text, this exhibit lists the most common errors in filing a tax return. The majority of these can be avoided by using tax preparation software, which error checks your return and walks you through correcting any found errors before allowing you to file. The odds of being audited are very low for most of us, and in fact, tax preparation software offers an estimate of your potential of being audited and why. There are 3 types of audit in increasing degrees of severity. A correspondence audit just means the IRS writes you asking for further information. An office audit requires you to appear with your tax preparer or attorney at an IRS office. A field audit is the most serious and involves IRS agents coming to your home or business to review all elements of your return and your supporting documentation. If you are notified of an office or field audit, you may request time to prepare. You can ask that the IRS specify exactly what's being questioned, and you have the right to appeal. It's up to you whether or not you bring your tax preparer with you. Be on time. Only bring what the IRS is asked about. Be sure you understand the relevant tax law that you're being questioned about. This is like giving a deposition. Answer only what is asked, calmly, in as few words as you can. Yes or no, if possible. Our final topic of the chapter is tax planning strategies. We want to practice tax avoidance. We only want to pay what we owe, no more. This requires understanding tax laws and their impact on our financial decisions throughout the year. Tax avoidance is perfectly legal and desirable. Tax evasion is illegal. Most commonly, this involves not reporting all income. Remember, income is not negotiable. Sometimes we can manage income and deductions to minimize taxes owed. This chart details those strategies. If rates are going down, take deductions this year. If they're staying the same, delay income if you can. You won't pay taxes on it this year. Burden the hand. If rates are going up, delay deductions and accelerate income. It can be hard to manage income like this, but with deductions it may be possible. For example, to accelerate a deduction into the current year, pay your January mortgage payment in December, so the tax and interest go in the current year. If planning a large deduction to a charity, do it this year, or hold off till next year, depending how the rates will impact the effect on your tax liability. You have 3 ways to use higher education expenses in filing your taxes: tuition and fees deduction, or 2 types of education credit. The tuition and fees deduction allows a reduction in adjusted gross income by a maximum of $4,000. The American Opportunity Credit allows a credit up to $2,500. You have to be enrolled at least half-time, and it's only good for the first 4 years of post-secondary education. The Lifetime Learning Credit is limited to $2,000. It can be used for part-time and graduate school, and it can be used beyond 4 years. You need to figure out which you qualify for and which would be the most attractive in terms of tax reduction. Probably the best tax shelter for the average taxpayer is buying a home. Mortgage interest and property taxes are deductible. Many years ago, all interest on debt was deductible. Now, only mortgage debt is deductible, but you can take home equity loan or second mortgage and use the money for any purpose while still deducting the interest. Be aware, though, that these are not to be used frivolously, as you have put your home up as collateral. Job-related expenses not reimbursed by your employer were allowed as deductions in 2017, but they have been eliminated in 2018. Healthcare expenses are also deductible with some pretty stringent limits. Health savings accounts, flexible spending accounts, and expense reimbursement accounts provide a way to reduce taxable income when paying medical and child care expenses. If you have significant expenses in these areas, it will pay to check out these deductions. Investment decisions can also affect your taxes. Municipal bonds offer a tax-exempt investment opportunity. Interest is exempt from federal tax and usually from any state tax in the state in which the bond is issued. Tax-deferred investments allow you to defer paying taxes, with the goal to pay taxes after retirement when you expect your rate will be lower. Tax-deferred annuities, health savings accounts, and IRAs and KEO plans fall in this category. Generally, you're not taxed on the gains in a stock or bond investment until you sell the asset, capital gains. The rate on assets held more than 1 year is lower. There are both tax advantages and disadvantages to self-employment. You can deduct health and life insurance, but you'll have to pay a self-employment tax covering Social Security and Medicare. If you have investment accounts for your children, they're taxed at either the parent's rate or a child's rate, depending on the child's age and the amount of investment income. IRAs have become the standard in retirement plans for those not covered by an employer's 401k or with income below a certain level. With a traditional IRA, amounts contributed each year are not taxed, but withdrawals are taxed as gross income. Annual contributions are limited to $5,500 per person, with larger amounts allowed for those over 50 in order to catch up. There's a penalty for withdrawals prior to age 59 and a half, unless the funds are because of death, disability, or for medical or higher education expenses. Required withdrawals begin at 70 and a half. With a Roth IRA, the contribution is not deductible in the year made, and the limit is the same, but earnings on the account are tax-free for 5 years, and withdrawals are exempt from both federal and state taxes. KEO plans, or HR 10 plans, allow self-employed individuals to contribute 25% of their annual income to any combination of a profit-sharing and pension plan, up to a maximum of $54,000 in 2017. 401k plans are employer-sponsored retirement plans that allow a tax-deferred amount up to $18,000 in 2017. Those over 50 can contribute larger amounts as with traditional IRAs. Some employers match contributions up to a certain amount, which makes a 401k even more attractive. Tax advisors recommend contributing as much as possible to 401ks or KEOs, since the value accumulates on a tax-free basis until withdrawn, and the contributions are tax-deductible in the year made. Coverdell education savings accounts are designed specifically to help parents with income under a certain level save for their children's college education. Contributions are limited to $2,000 per year and are not tax-deductible, but the funds can be used for educational expenses kindergarten through college. Finally, 529 plans are state-sponsored plans to assist parents in saving for their children's education. There's no tax deductions, but the funds grow tax-free and are not taxed when withdrawn. Tax laws usually change to some extent every year, so you need to keep up with any changes so you'll be ready when filing time comes. The text discusses changes as of 2017, some of which changed with the 2018 tax reform bill. From the text, advanced tax credits relate to ACA health expenses. There's penalties for no health insurance. Flexible spending accounts can carry over $500 year to year. Home office deductions have been streamlined. With the Tax Reform Act of 2018, the marriage penalty is mostly gone. The married filing jointly brackets are exactly double the single brackets. The standard deduction has roughly doubled, but the personal exemption has been eliminated. Short-term capital gains are still taxed as ordinary income. Long-term gains taxes are at 3 levels depending on adjusted gross income. The child tax credit has been expanded. 529 plan funds can now be used for all levels of education other than college, for example, tutoring. The mortgage interest deduction remains with a home price upper limit of $750,000. The charitable deductions limit has been raised to 60%, medical expenses threshold reduced to 7.5%. State and local tax deductions now have an upper limit of $10,000, especially contentious in high-tax states. The trade-offs are that some deductions have been eliminated or capped. Deductions for casualty and theft losses have been eliminated unless attributed to a federally declared disaster. Unreimbursed employee expenses are no longer deductible. Tax preparation expenses are not allowed either, and should make you think harder about using tax prep software costing about $50 to $75. Moving expenses are not deductible, and some others have been eliminated as well. Be sure to check carefully because items that were allowed last year may have gotten axed in the 2018 bill. Anytime tax reform is discussed, the idea of a flat tax or a VAT, a value-added tax, come up. A flat tax would apply the same percentage to all taxpayers. This truly would be postcard filing, but for many it would result in higher taxes paid since most, if not all, deductions would be eliminated. A value-added tax adds a tax to a product at each stage in its manufacturing process. These are very popular in Europe. The idea is that higher income taxpayers would pay more since they consume more. VATs usually start low, but have had a habit of quickly rising. For example, some of the higher current standard VAT rates include Austria, 20%, China, 16%, Denmark, 25%, France, 20%, Germany, 19%, Greece, 24%, Italy, 22%, Spain, 21%, United Kingdom, 20%. To meet Learning Objective 1, we reviewed the major types of taxes we pay with special attention to federal income tax. With Learning Objective 2, we carefully covered how to calculate taxable income and the amount of tax owed. Objective 3 covered actually preparing and filing your federal income tax return. Finally, we covered various tax planning strategies aimed at legally reducing the taxes you have to pay. The remaining slides are for auto readers.